people ask me for advice or whatever, and I say, like for instance, last year when the market tanked, I told people, do not sell, don't sell, don't sell. When you sell when the market is low, then you're locking in your losses. And I know at least 3 people that sold, at the bottom of the market. So that just proves like when you get in, you have to stay in long term, and you can't dance in and out the market like you said.
Yeah, I think that might be the single most critical thing to being successful, at least if you're following the simple path that I advocate. And I have said on many occasions, and I've written it on my blog, that my approach doesn't work if you're going to panic and sell. In fact, if you're going to panic and sell when the market's down, my approach will leave you bleeding by the side of the road. You should not be doing what I recommend. It depends on you being willing and able to weather the storm. In fact, I did a guest post from a friend of mine a couple of years ago. I can't think of the exact title, but if you go on the blog, you're curious, and in the search bar you put in warm, because that's the acronym he uses, and I don't remember what those letters stand for, but you put in warm, and he talks about an all cash strategy. So it's very important in investing, before you put in a dime, to really understand, as the philosophers say, know thyself, right? It's critical. And there's nothing wrong with looking inside yourself and saying, you know what? I know that I couldn't tolerate seeing 40% of my investment disappear overnight. Nothing wrong with that. That doesn't make you a weak person or a lesser person. That's just your psychology. And if you feel that way, if you look in deep inside yourself and you say, I know that if the market drops 40, 50%, I just don't want to deal with that. I don't want to, it's not a psychological thing that I want to have to deal with. Then you should find a different investment strategy than the one I outlined, because you've got to be willing to ride those storms. And you've got to be willing to know, not just in your head, but in your gut, that the storms, however terrible they seem, with all the media screaming about, the world's coming to an end, that it's not true and that things will get better. Might take a while, might take a couple of years. The turnaround last year was phenomenally quick. We can't expect that all the time, but you have to know. And then if you're building your investments over time, those drops actually work in your favor. Because if you're putting the same amount of money in every month as my daughter does now, then every time the market drops, you get to buy shares on sale. That's a good thing. Mm-hmm. And in fact, I've said that for young people who are beginning to build their wealth, the best thing that could possibly happen for them is a major market crash, because they're just beginning to put their money in. And as long as you keep putting money in, the market crashes actually work in your favor. But again, you gotta tie yourself to the mast, not let the sirens lure you onto the rocks.
I agree with you 100%.
Yeah.
So let's say someone is ready to, begin saving for their future, and they're terrified of the market. They, whatever you said today doesn't make any difference to them. They say, I'm just going to put it in a online savings account or in bonds or something very safe. What would you say to them, especially considering they have maybe 30 to 40 years until retirement?
Yeah, well, that's the first thing I would say is go to my blog and put in warm and read that guy's post on basically holding and investing in cash. I would never try to talk somebody out of that, because what they may be saying to me or to you is that, hey, I understand my psychology well enough to know that, well, I might know in my head that when the market crashes, it's going to come back. In my gut, I know I'm not going to be able to handle it, and I'm going to sell. And then, as I say, if you sell when the market crashes, my approach is going to leave you bleeding by the side of the road. you'll be better off with just cash or bonds. The problem with that is, especially long term, is that stocks so dramatically outperform that you will have a much longer road in accumulating wealth than you would otherwise. And so, again, I would never say to somebody who said, I just don't want to take the risk of stocks, I would never try to persuade them to take it. But on the other hand, I think it's a great tragedy to invest your money for 30 years in something that is, you're going to be running hard to stay in place because you're also losing money to inflation. You know, the value of your cash is going down. So stocks are an incredibly powerful engine for building wealth, but they're incredibly volatile, and you have to be willing to tolerate that volatility. And when it comes to balancing, so a question I get frequently is, well, how much stock should I have versus bonds, right? And bonds are ballast in your portfolio. That's why they're there. They're there to smooth the ride, the wild ride of stock volatility. So the more bonds you add, the smoother the ride will be. But stocks dramatically outperform bonds over time. So the more bonds you add, the lower your performance over time will be. And only, every individual has to make the decision for themselves as to what's more important to them, performance or a smooth ride. This goes back to the psychology thing we talked about earlier with debt, where I say, I'm a believer in adjusting your psychology rather than adjusting your investments to your psychology, because adjusting your investments to your psychology is expensive over time in terms of lost. But again, if you got to be sure you can actually adjust your psychology.